It's a very difficult question to answer because there are so many uncertainties. But if we try to look at possibly three things: the political situation around the Arab Spring, we can look at the resource situation, oil prices, and then we can look at the wider economy. Now, if we take the last one first, forecasts for this region, for the MENA region, are for growth of around 4 to 6%. Now, this is still substantially higher than what you will see in Europe or America or Japan, but it's considerably lower than the growth rates that have been forecast for either India or China. So not a top emerging market, but certainly an area which is going to show overall GDP growth. And that's been driven by high oil prices. We've had reasonably high oil prices ranging between 70 and 90 for the last 2 years. And of course, recently they've been above 100 for a fairly sustained period of time. So that's brought in, on the resource side, extra boost to the economy. We've also got the liquidity boost, and the printing, effectively the printing of money in America, feeds directly through to this region because most of the currencies are linked to the dollar, or are primarily linked to the dollar in the case of the Q80s. So we've also had a liquidity rush or boost. Now, so far this hasn't led to the type of bubble that we had in Dubai or throughout the region, which exploded so painfully in 2008 and 2009. So the region's actually been a little bit more cautious. There's still a lot of people restructuring their debt, and I think they're using this liquidity rush to effectively rebalance themselves, to clean up their balance sheets. Now, if you then go from the resources and the liquidity side to what's happening with the Arab Spring, this is, of course, a great source of uncertainty, not just for this region, but for the world. What we can say, though, is if you look at the cost or the fiscal break-even price of oil, which means if you're a government and you're selling oil at a particular price, what price of oil will allow you to meet your planned expenditures? The fiscal break-even price for oil has risen from an average of 70 in this region to 90. The Saudi government are putting in a fiscal stimulus of around 10% of the country's GDP to spread wealth faster throughout their country. At the moment, 30% of their government spending is on defense. So if you look at either the carrot or the stick in this region, both defense spending and social or government stimulus spending has gone up. And that really is a substantial, I mean, a very substantial increase to go from a fiscal break-even of 70 to 90, when most people believe that the fundamental oil price is around 90, means that perhaps there won't be such a great surplus coming out of this region in the future.